This is crazy. On a $500,000 mortgage, if you had a 7% interest rate, you would pay over $685,000 in just interest alone over 30 years. That means you will have borrowed $500,000 and paid back almost $1.2 million in total. The bank made more from you than you originally borrowed, just from interest. And the wild part? Most people sign a mortgage without really understanding how that number works. Not because they're not smart, but because nobody ever sat down and explained it clearly. That is exactly what I'm going to do today. I'm Scott, I'm a licensed mortgage broker, and this is episode 1 of Mortgage Story, the complete beginner's guide to how mortgages work. We're covering everything shown on this screen: what a mortgage legally is, the players involved, how your monthly payment breaks down, and why early payments are mostly interest. We will touch on how we calculate interest rates, the difference between your down payment and closing costs, how to build equity and real wealth through homeownership, and other strategies to slash the amount of total interest that you have to pay over the life of your mortgage. By the end of this video, you will understand your mortgage better than most people who already have one. Let's get into it. Once again, my name is Scott Stavis, and I'm a licensed mortgage broker. And what makes me a little different is that I work on both sides of the mortgage and real estate industry. I understand things through the eye of a homeowner, investor, and underwriter because, well, I operate on all sides of the industry on a daily basis. As a mortgage broker, I understand how lenders and underwriters think. I know what underwriters are actually looking for, how to make the process as smooth as possible, and how to position a buyer to get the best possible outcome. But I also understand what it's like to be on the other side of the table. I'm an active property investor, property manager, and am involved in fix and flip projects. So whether you're a first-time buyer who's never done this before, a homeowner looking to refinance, or a real estate investor building a portfolio, I know what matters to you because I work with people in each one of those positions every single day. Now back to our topic for today. Let's start at the very beginning. What is a mortgage? The simple version: a mortgage is a loan used to buy real estate where the property itself serves as collateral. That word, collateral, is the key. It means if you stop making payments, the lender has a legal right to take the property. Now here's the question I love asking first-time buyers. When you take out a mortgage, who owns the house? You do. From day one. Your name is on the deed at closing and you're the legal owner. But the lender holds something called a lien, a legal claim against the property. Think of it like a flag planted in the ground that says, this property has a debt attached to it. When you make your final payment, that flag comes out and the lien will be released. At closing, you sign 2 separate documents that most buyers never fully read. The first, the promissory note, is your personal promise to repay the loan. The second is the mortgage or deed of trust, the document that gives the lender their security interest in the property. Understanding what you're signing is the starting point for everything else we're going to talk about today. And the last card on this slide is the most serious: default and foreclosure. If a homeowner fails to make payments on the mortgage, the lender can initiate foreclosure, a legal process to take ownership of the property and recover the debt. It takes months, not days, to execute a foreclosure, and it's important to understand that this process exists to protect the lender. Before we go any further, let me introduce you to the full team that's involved in your mortgage, because there are more people involved than most buyers realize, and knowing who does what will save you confusion throughout the entire process. First, the lender. This is the source of the money. Banks, credit unions, mortgage companies. They fund your loan from their own capital. They set the lending standards and decide what they'll approve and on what terms. After closing, they may hold your loan or sell it, but more on that shortly. On the second card of this slide, the broker, that's me, and this is an important distinction I want you to understand. Using a mortgage broker is different than going directly to a bank. I don't lend my own money. Instead, I work with multiple lenders simultaneously, which means I can shop your loan across dozens of institutions and find the best rate and program for your specific situation. A bank, on the other hand, can only offer you their own in-house products. I can offer you the entire market, and often the tech programs and systems that us brokers use allow us to operate much faster than large institutional lenders. I personally have finalized a home purchase for a client of mine in less than 10 days from start to finish. In another episode, we will go over strategies to help you win a contract on a home. And trust me when I say speed, speed wins in this industry. On top of that, I'm a licensed professional with a fiduciary duty to you, meaning I'm legally required to act in your best interest. Next up is the servicer. Here's one most first-time buyers don't know about. The servicer is the company you actually send your mortgage payment to every month. It might be your original lender, or it might be a completely different company. Loans are bought and sold on a secondary market, and servicing rights often get transferred. If you ever get a letter saying your loan has been moved to a new servicer, don't panic. Your interest rate doesn't change, your loan balance doesn't change, and your monthly payment doesn't change. Only the mailing address for your payment changes. And finally, the underwriter, the most important person in your transaction that you will probably never meet or speak to. The underwriter works for the lender and reviews your complete file, your income, assets, credit history, and the property appraisal, and makes the final decision. Approved, denied, or approved with conditions. Meaning, we approve your loan if you can provide additional documentation. When a lender asks for more paperwork, it's usually the underwriter who requested it. Now let's talk about your monthly mortgage payment. Most people think their mortgage payment is just principal and interest. It's actually 4 things, and they have an acronym. P.I.T.I. P is principal. This is the portion of your payment that actually reduces your loan balance, that directly builds your equity. In the early years of a mortgage, this is a surprisingly small fraction of your total payment, and we're going to look at exactly why in the next section. But every dollar of principal paid is a dollar of equity in your pocket. I is interest, or the cost of money. It's calculated monthly on your remaining loan balance. This is the largest part of your early payments, and it decreases very slowly over time as your balance goes down. T is taxes. Your annual property taxes divided by 12 are collected monthly and held in an escrow account. Your lender pays your property tax bill directly to the county on your behalf, usually twice per year. And I is insurance. Your homeowner's insurance premium divided by 12 is also collected monthly and held in escrow. Lenders have a significant financial interest in your home, and they are constantly monitoring your insurance coverage as they need to know the home is protected. One housekeeping item to mention: on some loan products, you may have the choice to pay your insurance and taxes outside of the monthly payment. All 4 together make up your total monthly mortgage payment. And here's an important nuance worth knowing. Your payment can change slightly from year to year. Property tax assessments can increase as home values rise and insurance premiums adjust at renewal. Your servicer reanalyzes your escrow account annually and adjusts your payment accordingly. This is completely normal, not a surprise fee or an error. Okay, now I want to show you the most jaw-dropping thing in this entire video, and it is something that surprises almost every single buyer when they see it for the first time. It's called amortization. Let's take a $500,000 mortgage at 5% interest, for example. Your monthly payment is going to be approximately $2,684. In year 1 alone, just the first 12 months, $24,832 of your payments goes to interest, and only $7,377 goes to actually paying down your loan balance. That is 77.1% of your payments going to the lender as interest, and only 22.9% reducing what you actually owe. Now look at the chart on the right. This is what 30 years of payments looks like. Look at that first bar. Almost the entire thing is orange. That is your interest. By year 10, you've made over $322,000 in payments, and you've barely moved the needle on your balance. It's not until around year 15 that you hit a 50-50 split. And only in the final years does the green really start to dominate. This is how amortization works. The lender front loads the interest. In other words, the early years, almost every dollar you pay goes to them. In the later years, almost every dollar reduces your balance. Now here is the critical insight, and this is actionable information you can use immediately. Every extra dollar of principal you pay in the early years eliminates a disproportionate amount of future interest. Starting in year 1, if you make 1 extra mortgage payment per year, you can cut a 30-year mortgage down to 21.5 years. And what does that equate to exactly? Saving tens to hundreds of thousands of dollars in the long run. Did you know that? The math is heavily in your favor if you understand how to use it. This is one of the things I map out for every client I work with. Not just what you can afford today, but how we can structure payments to build wealth faster. Please make sure you like this video and subscribe to my channel. Each video features key tips similar to what we just went over. Now let's talk about something that confuses almost every buyer I work with. Where does your specific mortgage rate actually come from? And why is your rate different from what you see on the news? There are two levels to this, the macro and the micro. At the macro level, mortgage rates are driven by market forces. And here's the most common misconception. Mortgage rates do not follow the Federal Reserve rate. The Fed sets the overnight rate that banks charge one another. On the other hand, mortgage rates generally follow the 10-year Treasury yield instead. When investors feel uncertain about the economy, they buy Treasury bonds. Bond prices go up, yields go down, and mortgage rates tend to follow them. This is why rates sometimes drop when bad economic news comes out. Inflation is the other big macro driver. High inflation means lenders need to charge more to preserve their purchasing power over a 30-year loan. And your loan itself, once funded, is very likely going to be bundled into a mortgage-backed security and sold to investors. The demand from those investors for MBS bundles directly affects the rates lenders can offer. For most, this is surprising to hear, but interest rates are more connected to Wall Street than most homebuyers ever realize. Now, the micro. What determines your specific rate compared to someone who applied on the exact same day with the exact same loan amount? For starters, credit score is the biggest single factor. Lenders price their rates in tiers, and every 20-point bucket can move your rate. A borrower at 760 gets meaningfully better pricing than a borrower at 680 on the exact same loan with the same lender on the same day. Next is your loan-to-value ratio, or LTV, how much you're borrowing relative to the home's value. The more you put down means less risk for the lender, which results in better pricing for you. And then your debt-to-income ratio, or DTI. Higher DTI signals more financial stress. Lenders price that risk into your rate at times. That takes us to your loan type. The most common loan types are FHA, VA, USDA, and conventional loans, and each come along with different guidelines, qualifying criteria, and different pricing. By the way, VA and USDA loans often have the lowest interest rates if you qualify for them. Book a call with me to run through the various loan types and see which ones you qualify for. And lastly, property type. A single-family home gets the best pricing. Condos, multifamily homes, and investment properties all carry premiums. This is exactly why working with a mortgage broker matters. I look at your complete profile, your credit, DTI, your down payment, your loan type, and match it to the lender whose pricing is best for that specific combination of factors. Going directly to one bank means accepting whatever that bank happens to offer you that day based on their in-house programs. I, on the other hand, can give you the entire market. All right, now that we're past some of the technical aspects of the mortgage world, let me cover one of the most consistent financial surprises I see with first-time buyers. And I want to save you from it right now. Most buyers plan for their down payment. They save, they know the number, they're ready. What they often don't plan for, because nobody told them, are closing costs. Your down payment is the initial equity you put into the home. On a $400,000 home with 3.5% down, that's $14,000. Most buyers know this number and have it saved. But at the closing table, you're also going to owe closing costs. And these are separate from and in addition to your down payment. Closing costs typically run 2 to 5% of the loan amount. On a $400,000 loan, that's potentially $8,000 to $20,000 in additional cash due on the same day. You might be thinking to yourself, Scott, why is there such a huge spread between those two figures? And that has to do with the state in which the property is located. Some states have higher transfer taxes and other costs that we will get into in a future episode. Now, which fees are included in closing costs? If you turn your attention to the right side of the current slide, first we have lender side fees, underwriting and processing. Also, you'll have to get the home appraised, which typically runs $500 to $900. title insurance, which protects both the buyer and lender against any ownership disputes, and county recording fees for transferring the deed. And finally, prepaid items. Your first year's homeowner's insurance premium paid up front, plus the initial funding of your escrow account for property taxes. Now, here's the good news. On an FHA loan, sellers can contribute up to 6% of the purchase price toward your closing costs. That's $24,000 on a $400,000 home. On a conventional loan, by the way, the limit is 3%. Pay attention here if you would. Exactly how to negotiate to have the seller pay your closing costs is something I work through with every buyer I represent. It can dramatically reduce your out-of-pocket cash at closing. In a later episode of Mortgage Story, I will have a complete video dedicated to strategies to win contracts. If this is something you'd like to dive into now, book a one-on-one call with me. The link is in the video description below. Now, let's walk through the full timeline, from the moment you decide you want to buy a home to the moment you take the keys. Step 1, pre-approval. This is your golden ticket, and it should be your very first step. Before you attend a single open house, before you fall in love with any property, get pre-approved. Your lender reviews your income, credit, and assets and issues a pre-approval letter. Real estate agents require it, and sellers expect it. And it protects you from the heartbreak of falling in love with a home you can't actually finance. This step takes just a couple of hours once your application is in. Do it first, always. And if you don't qualify right now, as part of my role, I'll map out a 2 to 6 month path for you to position yourself to buy later in the year. Step 2 is underwriting. Once you're under contract on a property, the full investigation begins. Your underwriter reviews everything. An appraiser goes to the property and produces a formal valuation, while the title company searches the ownership history of the home for any liens or disputes. At this point, you might receive a list of conditions, additional documentation the underwriter needs before issuing final approval. This phase typically takes 2 to 3 weeks, and patience and responsiveness here make all the difference. Step 3, closing. This is the day. You sit at a table, usually at a title company, and sign the promissory note, the mortgage, and several supporting documents. You pay your down payment and closing costs, and the title company records the deed transfer in your county's records. And then, finally, the keys make their way into your hands. And lastly, step 4 is servicing. Now you are making monthly payments on the debt. Know that your loan may be sold to a new servicer at some point in time. Your terms will never change if this were to happen. Monitor your property value and equity. If rates drop significantly in future years, refinancing is always an option. And stay in touch with your broker. That's what I'm here for. Okay, hang in there, everyone. We are cruising towards the finish line. Next up, let's talk about PMI, private mortgage insurance. This is one of the most misunderstood line items on a mortgage payment. Here's what PMI actually is. When you put less than 20% down on a conventional mortgage, the lender requires you to pay for insurance that protects their interest, not yours, in case you default. Let me say that again clearly. You are paying for insurance that benefits the lender. You get no direct benefit from PMI. And how much does PMI cost, you may ask? Typically 0.22 to 1.15% of the loan amount per year, paid monthly. On a $400,000 loan, that's $75 to $385 per month added to your payment. Your credit score and percentage of down payment are two of the main factors that can affect your specific PMI rate. Now, how do you get rid of your PMI, you may be wondering? On a conventional loan, your lender is legally required to cancel PMI when you reach 22% equity. But you don't have to wait. Once you hit 20% equity through payments, appreciation, or both, you can formally request cancellation in writing. 2 quick notes for you when it comes to mortgage insurance. FHA loans have their own version called MIP. We cover this in detail in episode 2. And VA loans have zero mortgage insurance. ever. That's one of the biggest advantages of VA loans that eligible veterans and service members can capitalize on. I know. We've covered a lot of financial principles today. Now, I want to close the educational portion with the reason all of it matters. The reason a mortgage, done right, is one of the most powerful wealth-building tools available to the average American. The concept is equity. Equity is the difference between what your home is worth and what you still owe. If your home is worth $400,000 and your loan balance is $300,000, you have $100,000 in equity. That is a chunk of your net worth sitting in that property working for you. Your equity grows in two ways. First, by paying down principal. Every mortgage payment, no matter how small the principal portion is in the early years, reduces your balance and increases your equity. And as we talked about with amortization, extra principal payments early on have a long-lasting effect. The second way to build equity and wealth is through home appreciation. Homes in the USA have historically appreciated at roughly 3% per year on average. On a $400,000 home, that's $12,000 in value added every year, while you sleep, while you work, while you live your life. Now here's the leverage math that makes real estate unlike almost any other investment. You bought a $400,000 home with $14,000 down, 3.5%. In year one, if that home appreciates 3%, you gained $12,000 in equity on a $14,000 investment. That's an 86% return in 1 year. You own the entire asset, not just the portion you put down. That is the power of leverage in real estate. And it is a power that renters simply do not have access to. And as that equity accumulates over time, it becomes usable wealth. You can tap into it through a cash out refinance or a home equity line of credit to fund investments, renovations, education, or other life goals. Your home is not just a place to live. It is a financial asset that works for you every single day. One more thing to note, and always verify this with your CPA because tax laws change. Homeownership comes with significant tax advantages. Once you become a homeowner, you can deduct your yearly mortgage interest expense and your property taxes, saving you thousands of dollars come tax time. And the capital gains exclusion, meaning married couples can potentially exclude up to $500,000 in profit from taxation when they sell their primary residence. No other investment class offers this kind of exclusion. Make sure you consult with a tax professional about what applies to your personal situation. All right, and finally, let's bring this all home. Here are the 10 things that I want you to walk away knowing from this episode. First, a mortgage is a secured loan. You own the home from day one, and the lender holds a lien until it's fully paid off. 2, know your team. The lender funds it, broker shops for you, servicer collects your payment, underwriter approves it. 3, your monthly payment has 4 parts: principal, interest, taxes, insurance. All 4 matter. 4, early payments are mostly interest. That's amortization, and extra principal early can save you years and tens to hundreds of thousands of dollars. 5, your interest rate is personal to you, and your credit score, DTI, down payment, and loan type all move it. The news rate is not your rate. 6, budget for your closing costs. 2 to 5% on top of your down payment. Know both numbers before you shop. 7, PMI is not permanent. You can cancel it at 20% equity on conventional. 8, equity is your real wealth. It grows through payments and appreciation. 9, pre-approval comes first, always, every time, before you fall in love with a house. And 10, if your loan gets sold to a new servicer, your terms never change, ever. And the quote at the bottom of this slide is something I mean genuinely. I don't just look at your loan, I look at how this decision impacts your long-term wealth. That's the difference between getting a mortgage and building a financial strategy. If you watch this entire video, you now understand mortgages better than the majority of people who have already bought homes. That knowledge is genuinely valuable, and I want to make sure you can apply it. If you found some value in this video, there are 2 things I'd love for you to do right now. Like this video and subscribe to my channel to help us grow. There's a new episode every single week, and in the next one, we go deep into FHA loans, the most searched loan program on YouTube. And if you're ready to go from learning to action, book a free discovery call with me. The link is in the description. In about 15 minutes, we'll look at your actual numbers, your income, your credit, your savings, what you're trying to buy, and map out exactly which programs you qualify for, what your estimated payment would look like, and what, if anything, you need to do to get ready. No pressure, no pitch, just real information about your real situation. That is what Mortgage Story is built on. Every home has a story, and I'm here to help you write it. So from wherever you're tuning in from across the USA, good afternoon, good evening, and good night. My name is Scott, this is Mortgage Story, and I'll see you in the next one.